In my mind, I'm gone to Carolina. Can't you see the sunshine?
Greetings and welcome back to Fisher Wealth Management's Tips of the Week. With any investment approach, it's crucial to have a plan, and the bedrock of any investment plan is to have a well-diversified portfolio among various asset classes. The rationale behind diversification is to mitigate risk, as you never know when something could adversely affect one of your investments. If you had a portfolio concentrated in equities in 2008 or in energy-sensitive securities following the recent stock market drop in oil prices, you would have lost a significant amount of your investment value. We diversify portfolios to seek to reduce this risk. However, simply because a diversification has been an effective way to potentially reduce long-term risk during periods of time, by definition, you would expect it will outperform some years and underperform others. Unfortunately, this can be painful when the outperforming asset class is the most well-known United States index, the S&P 500. An index of the 500 largest United States publicly traded companies. This is exactly what happened last year in 2014. The S&P 500 significantly outperformed many other often diversifying classes of assets, including small cap stocks. The S&P outperformed them by 9%. Foreign and developing stocks were outperformed by the S&P by 18% last year. Therefore, a diversified portfolio last year would have significantly lagged the S&P 500. So then, why not just invest in large cap US stocks or just invest in the S&P 500? Over the past 20 years, the S&P 500 has only outperformed all other major asset classes, including the small cap, mid cap, international, and emerging market stocks. It's only outperformed them 30% of the time. And it was actually the worst performing class of asset 25% of the time. So it's important to stick with your investment plan and be invested in several different types of investments. Diversification has historically worked. And as we look to 2015 so far, it looks like it's starting to work again. In 2015, we continue to look for places to effectively diversify, and we are closely monitoring potential opportunities in Europe. The European Central Bank is taking aggressive steps to stimulate their economy. As commodity prices stabilize, emerging market stocks could join the global growth trend. After decades, Japan emerged from deflation with a massive stimulus effort, which may continue to offer an investment opportunity. There are many potential opportunities on the horizon, and as we look ahead, we believe returns may come from a much broader set of investment choices. As we have already seen and begin to see in 2015. So, keep with your portfolio, keep with your diversification. If you're not having these types of conversations with your advisor of choice, we do welcome you to call us down here at Fisher Wealth Management. And thanks again for tuning in for Fisher Wealth Management's Tips of the Week.
In my